Welcome to the lecture 2 on the prologue to financial statement analysis. In lecture 1, we have discussed more or less the objectives, the pragmatic outcomes and different other dimensions which are facilitating the variations of financial decision making process. And we have also touched upon different stakeholders backed by varied objectives and interests with regard to financial decisions. In this lecture, we are going to delve into the framework on which those financial documents are prepared and generated. At the backdrop of different fraudulent practices which are adopted by different users as well as different aggregators of financial information at the time of dissemination of financial information to the different users community, it is essential and imperative on the part of the regulating agencies to come out with certain standards and parameters as well as benchmarks in order to ensure a proper dissemination of financial information which is comparable and which is robust so far as its subsequent use is concerned. In tandem, when you are going to talk about regulatory framework which is more or less dictating or governing the preparation of financial documents, though it varies from countries to countries, but there prevails the regulating agencies to country specific issues, and at the same time they are also taking due care to the fact to reduce and minimize the prevalence of financial frauds in terms of dissemination of information as well as financial misrepresentations, financial manipulations, financial reporting frauds in order to nullify the unfavorable consequences of financial decision making process. In a country like ours, the apex agency, the Institute of Chartered Accountants of India, who is the entity authorized to draft accounting standards which are otherwise specifying the framework to disclose different financial information through the preparation of different documents, and at the same time it is also duly accorded by the ministries representing those domains of the government architecture. In the same manner, when you are going to talk about the framework which is there in the Western countries, as United States being the hegemon, more or less dictating and governing the world of financial affairs, they have their own standards, that is generally accepted accounting principles, which are issued by AICPA, American Institute of Certified Public Accountants, and all those countries who are listed in the United States and conducting and convening business activities are mandatorily required to comply with the standards prescribed and issued by AICPA in lieu of gaps to comply with the regulatory requirements. Moving in the same direction, the International Accounting Standard Board also issues international accounting standards, because with the opening up of different economies and cross border trades which are gaining prominence by the passage of time, it is imperative on the part of transnational agencies like International Accounting Standard Board to come out with certain regulatory frameworks which are going to be applicable to all those transnational as well as multinational business entities who are conducting and convening businesses simultaneously in different countries to serve their very interests. But at the same time, it is also equally sensitive to take a note of the fact that if a multinational company is belonging to United States, but it is having businesses in the Scandinavian countries, having businesses in European countries, having businesses in Asian countries, those companies, those subsidiaries are falling prey to the accounting standards issued by the respective countries where they are conducting and convening business. Now, that is one of the typical challenge which is addressed through international accounting standards issued by International Accounting Standard Board. Moving further, with the assortment in different accounting standards issued by different regulating agencies pertaining to different countries, the need of the hour is to harmonize and minimize the differences in the accounting framework by using which the companies are preparing and disseminating their financial information. In relation to that, the International Financial Reporting Standard are coming into existence, which is indirectly the outcome of the harmonization process in terms of accounting rules and regulations by adhering to which different financial documents have been drafted and prepared, and further it will be made available for its subsequent use by all those interested parties, whether outsiders or insiders, in order to serve their vested purposes. In same line, when you are going to talk about only the financial information, obviously it is getting addressed through different accounting standards, international accounting standards, international financial reporting standards. But what about the other dimensions of information which are now gaining prominence during the last few decades? Indirectly, I am hinting upon the qualitative disclosure domain, which is more or less addressing the other aspects of business except the financial states of affairs. And for that, no regulating agencies were there in the last decade. But nowadays, with the gaining prominence of different societal issues like climate changes, threat to environments, then carbon footprints and all these things which are more or less hovering around, and it is the equitable responsibility of those corporate entities who are conducting and convening business by consuming the resources of an economy, either directly or indirectly, they are also answerable for that, and they are also expected to disseminate different information related to societal activities, related to environmental activities, related to governance activities, which is going to contribute towards the sustainability of business, as well as it is also equally sensitive for those users of financial statements who are not only interested to know what is happening in a particular company in terms of financial terms, rather they are equally inclined to know what is happening in terms of the role expected on the part of the company towards the society and towards the societal cause in general. So, to serve that purpose, the sustainability standard disclosure came into existence fairly recently. It is issued by ISSB, which is one of the subsidiary of IFRS, who is taking that responsibility to come out with some framework, rules and regulations and the further dimensions to cover off the governance, societal and environmental activities which are taken up by the body corporates for the holistic and sustainable objective. Moving further, we all know that regulatory framework is essentially addressing do's and don'ts. Now, what is to be done and what is to be restricted, what is not to be done. The rules are made for that. Rules are guiding us and allowing us to do the things the way it is expected and prohibiting us not to do anything which is detrimental to all the stakeholders in general. Now, in that context, by the passage of time, different accounting standards have been issued addressing different financial metrics, different financial items which are disclosed in different financial statements prepared by the corporate world. To start with, I am going to put thrust upon the Indian accounting standards, because more or less the students who are pursuing different courses at UG, PG and professional level in India, they are required to at least have some elementary exposure to the accounting framework developed and in place in our country to regulate the dissemination of financial information to the best possible extent. Now, I am jotting down some of the Indian accounting standards issued by ICAI. To start with, AS1 is catering to the presentation of financial statements, because if you will leave all the body corporates open ended, they will make use of their own whims and fancies to prepare the financial statements and furnish it to serve different purposes. And if different companies are there to prepare the financial statements in different formats, in different ways, by using different headings, by using different follow-ups, it is not possible at the end of the users to generate a consensus, and at the same time it is not possible to develop a comparative orientation when we are talking about the stakeholders. Specifically, if I take for example the competitors, when they are keeping an eye on their peers and their financial states of affairs, what are they doing? What are the strategies? What are the financial tools they are using? How are they managing the financial states of affairs? If a particular company is having 4 peers with whom he is taking keen interest, and all those 4 peers are preparing their financial statements in different formats, it is difficult at the end of the company to arrive at a conclusion with regard to the financial states of affairs. Similarly, take for example another stakeholder, that is the investors community. When they are on the verge of taking the investment decisions, they are going for due diligence with regard to the financial states of affairs of a company before committing their capital in any company and creating a portfolio. In that context, when the potential investors are getting access to financial statements and there is no uniformity in the formats in which different companies are presenting their financial statements, it is very difficult on the part of the potential investors to arrive at any conclusion and deduce any takeaways which is going to facilitate their investment decisions per se. So, it is imperative on the part of the regulating agencies to come out with a uniform format and to make it mandatory for all the companies to furnish and disseminate the information by strictly complying to that format. And that facilitates the varied purposes of the users of financial information. Moving further, when you are going to talk about inventories, those who are hailing from accounting background, they are a little bit conversant, but when we are talking about financial statement analysis and we are addressing a larger community, we cannot all the time take it for granted that whosoever is pursuing MBA or whosoever is pursuing anything which is related to finance is having a commerce background, have had some prior knowledge about all these things. So for that, when we are talking about inventories, it is one of the area in the domain of accounting which is full of loopholes, full of possibility to misrepresent, to manipulate the financial states of affairs, because the valuation of inventories and the ways they are ascertained so far as their cost is concerned, they are varied. Say for example, when we are talking about inventories in the form of raw material, there are different methods of pricing the issue of material when we are ascertaining the cost per unit of output. So if the method of inventory is varying, the material cost which is charged to calculate the cost per unit is also going to vary. Now the question comes, if there will be no framework, there will be no regulatory orientation with regard to the method to be used for pricing the issue of raw material and charging it to the cost per unit of output, it is very difficult on the part of the stakeholders community to arrive at any legitimate conclusion with regard to the profitability, with regard to the efficiency with which the inventories are getting converted into cash, with regard to the disclosure of different information pertaining to inventory. So that is the reason why the ICAI came out with a separate standard which is addressing the issues related to inventories, its valuation, its representation in the financial statements and related treatments associated with inventories. Moving further, we are going to talk about AS7, which is going to address the statement of cash flows. We all know that traditionally the preparation of cash flow statement was not made mandatory, but nowadays it has been made mandatory on the companies to disclose the cash flow statement along with the income statement and balance sheet every year to all the users community in the public domain. Now, when we are talking about cash flow statement, why there is a separate accounting standard and what is the need of it? Because when we are talking about cash flow statement and its different facets, it is imperative to come out with a uniform protocol through which all the companies are expected to disclose and disseminate their inflows and outflows as a result of different activities executed during a particular financial year. Unless and otherwise we are going to make it uniform, it would be difficult on the part of the users community to deduce logical and cogent information related to cash flow, because when we are talking about cash flows, there are many companies who are intentionally either delaying the cash flows or leading the cash flows in order to misrepresent their financial states of affairs. So in that context, in the absence of a pertinent framework which is going to deal with operating cash flow, financing cash flow, investing cash flows and their subcomponents, it is very difficult to ensure that the very purpose for which the cash flow statement is prepared is going to serve at the end of the users of cash flow statement, backed by the very objective of taking financial decisions. Moving further, which is also a very sensitive one, it is catering to the income tax and related issues. We all know in a fiduciary system like ours, the governments and the quasi-government institutions, they are generating majority of their inflows by levying taxes in general on the individuals as well as on the body corporates. Now, when it comes to body corporates, the corporate entities are also equally aware of the fact and they are always on the verge, they are always in the foray to enter into a state of tax avoidance. Now, how to restrict the tax avoidance orientation? Because on the one hand, those who are the potential assessees who are expected to pay tax, they are trying to reduce to their level best the quantum of tax liabilities. On the other hand, the governments who are more or less dependent on the tax as a sources of revenue to take up different developmental activities. So, here there is a tussle between the two parties when we see to the government in one hand and the corporate world on the other hand. And there is every possibility that the corporate world is thriving its best to indulge into all sorts of practices and approaches through which the tax liability tend to be reduced. On the other hand, the government is also equally interested to ensure that the corporate world is paying the taxes legitimately what is supposed to be paid based on different parameters. Now, for that it is imperative on the part of the regulating agencies who are drafting and accommodating different aspects of financial information dissemination to come out with clear-cut framework and clear-cut regulations along with all possible instructions to facilitate a fair protocol with regard to tax accounting, because it is one of the very sensitive aspect which is going to have a direct bearing on the net profit available to the stakeholders community, because majority of the decisions are more or less taken on the basis of the profit or income net of tax liabilities. So, that is why always the companies are trying their best to show higher income on certain cases, but at the same time they are also backed by the very objective to reduce the tax liability. So, when we are talking about the users of financial information, they are interested in fair disclosure practices, but the question is whether the tax liability and its protocol of ascertainment is fair enough, whether it is duly charged while calculating the income net of tax, that matters a lot. That is why there is a separate accounting standard which is accommodating income tax. Moving further, when we are talking about the infrastructure, which is the essence of every corporate, because the infrastructure and its use and application leads to revenue generation and growth. Now, when we are talking about different infrastructures, there comes all the immovable assets, all the plants and machines which are falling under the accounting terminology of fixed assets, and their treatments and disclosure while preparing different financial statements. There is heavy prevalence of manipulations which were witnessed in the past with regard to the treatment and disclosure of fixed assets, property, plant and equipments. In order to nullify all those fraudulent practices and to disclose all these things, it is essential to come out with different properties and different rules pertaining to these standards. Then moving further in a swift manner, AS 109 talks about financial instruments, different financial instruments which are floated and issued for the purpose of mobilization of capital by the corporate world nowadays. They are to be regulated. Moving further, AS 115, which is revenue from contracts and customers, because there is heavy prevalence of malpractices and anomalies which are witnessed while we are talking about contracts and its valuations. Then similarly, the lease accounting. Now, after having an elementary discussion pertaining to different standards issued by the Indian regulating agencies, I am directly getting into the contemporary standards which are catering to the ESG, specifically the social, environmental, social and governance dimensions of business, which is adding off to the quantum of disclosure disseminated by the corporate world nowadays. Now, when we are talking about sustainability accounting standards, they are drafted by international sustainability standard boards under the aegis of International Financial Reporting Standards Foundation to develop comprehensive sustainability related disclosures covering areas like environmental, social and governance issues. Now, what are the very objective or aim to develop such standards? Here there are certain points. When we are talking about the very objective of sustainability standards, it is cogently backed by the material information relevant to investors, which could include disclosures on governance practices, board oversight, risk management, business ethics. Similarly, climate related risks and opportunities, for example, alignment with TCFD recommendations. TCFD is the task force which is created for financial disclosure pertaining to climate related risk, and that is created under the aegis of United Nations Environmental Program, UNEP, who established TCFD, Task Force on Climate Related Financial Disclosure, because we all know what a threat is posed by the transitions in the climate to the society at large and to all of us, irrespective of any geographic location on this planet. So, that is one of the fundamental essence of coming out with sustainability standards. Moving further, when you are going to talk about the environment, we all know the industrialization and its growth and development is to a certain extent a threat to the ecological balance, is a threat to the environment. There are a lot of practices which are adopted in industrially developed nations with regard to environmental disasters. Now, how to address all these things? For that, sustainability standards also accommodate environmental factors such as emissions, water usage, biodiversity, energy consumptions and flotation and facilitation of those resources which are renewable. Because when you are going to extract more from the environment and you are using more of non-renewable sources, one way or the other you are going detrimental to the society at large. Moving further, it is essential to accommodate the social factors. When you are talking about labor practices, when you are talking about human rights, when you are talking about community relations, earlier the corporate world did not pay heed or attention to all these dimensions. But nowadays we all know those companies who are the front runner companies, who are the best companies in different sectors, for them the most valuable resource is their human resource. unless and otherwise we are there to take care of their interests, their expectations in general, and unless we are there to take care of the society, because each and every employee is a representation of the society. So, all the companies are expected to contribute and come forward to uplift the society at large in different dimensions. There are many ways and means of getting these things done. Now, specifically when you are talking about sustainability standards, it is addressing governance practices which are more or less the internal states of affairs, including board oversight, business ethics, the climate related issues, the environmental factors, the social factors, as well as all those things which are falling under the broader domain of these areas which are coming off, and it is taken off very seriously by the coming generation, whether they are business entities, whether they are investors, whether they are banks, whether they are financial institutions, whether they are customers, because nowadays the customers are also expecting environment friendly products and they are more inclined and biased towards all these things. Now, with this I came to an end and I have delved briefly into the regulatory framework which is serving the fundamental premise to move further and make use of financial information for the purpose of analysis and deducing financial decisions in a cogent manner. Thank you all for patiently.